Greetings. This is information compiled for the IRS Reddit community and anyone interested in how ultra-wealthy individuals and corporations avoid short-term capital gains tax. More than $160 billion in tax revenue is lost yearly because the top 1% finds ways to avoid paying their fair share, according to research cited by the Treasury Department. Gains from long-term investments, such as stock sales, are taxed at a lower rate. Ultra-high net worth individuals, UHNWIs, with at least $30 million in investable assets often pay a lower tax rate on long-term capital gains. UHNWIs mainly invest for the long term to limit capital gains taxes and offset these gains with capital losses. They avoid capital gains tax because they usually hold multiple investments simultaneously. Some will pay off, and some will lose money, and their portfolio is large enough to offset the gains, and they still make an overall profit. The tax system in the U.S. benefits long-term investors, while short-term investments remain taxed at a higher rate than long-term investments. Most UHNWIs are long-term investors whose assets, mostly owned for over 1 year, receive favorable long-term capital gains rates. Tax policy encourages holding assets for over a year. Taxes on long-term capital gains is usually lower than if the same asset sells in less than a year. How do ultra-high net worth individuals avoid short-term gains? Here are a few examples. Day traders using the mark-to-market method. A day trader can file to mark-to-market securities or commodities, allowing the deduction of more than $3,000 in losses and changing the security value to the new market value at the start of every year. Essentially, this resets any gains or losses to $0. Tax loss harvesting, or a method where a taxpayer or corporation intentionally sells stocks, mutual funds, ETFs, or other securities held in a taxable investment account at a loss. Any excess losses of either type to offset additional capital gains first. If losses exceed yearly gains up to $3,000 can offset other taxable income, and further losses carry over to use in subsequent tax years. The 1031 exchange. A 1031 exempts real estate investors from capital gains taxes on profits made on investment properties if they use the proceeds towards purchasing other investment properties with equal or more value. Charity. Donating shares of stock to a charity offers two other options for the ultra-wealthy, on top of funding their inspired social causes. The market value of shares on the day they are donated to the charity is deductible if they are eligible for itemized deductions. They will not be liable for taxes on any capital gains due to the increased value of the shares. Buying and holding small business stocks. Qualified small business stock refers to shares issued by an eligible small business as defined by the IRS. If the stock qualifies under IRS Section 1202, up to $10 million in capital gains may be excluded from income. This tax break incentivizes investment in these smaller companies, depending on when the shares were acquired. Between 50% and 100% of the capital gains may not be subject to taxes. Hoarding. If you hold your stocks until your death, you will never have to pay any capital gains taxes during your lifetime. In some cases, heirs may also be exempt from capital gains taxes while claiming a step-up in the cost basis of the inherited stock. The cost basis is the cost of the investment, including any commissions or transaction fees incurred.